Okay, you're good?
Fantastic. Good morning, everybody, or afternoon or morning, I don't know, whatever time zone you're on. This is Grace Bernard, and we're going to be getting started here in just a minute. I'm just going to go over the 11 o'clock starting time by a tiny bit because we have about 150 people trying to get onto this presentation, so I want to make sure everybody has time to get on. I'm also going to unmute somebody real quick just to make sure that the sound is working for everybody, so I'll find a person. Zach, are you there?
Good morning. Yes, everything's coming through great.
Fantastic. Well, thank you for being the little guinea pig.
My pleasure.
Okay, so we are going to talk about a couple of updates until everybody gets on the phone and has a chance to log on, and I'm kind of watching as everybody's registering and getting on here. So let me go over just a couple of things that are going on with the tranches. We just closed and funded, is it Terry, is it group 8? 7. We just closed and funded what we call individual group 7. We're starting on group 8. We will sweep and fund those in September. So anybody that's trying to sell these to small businesses, individual people, et cetera, you can start collecting the applications on those right now and get those ready for group number 8. Now, if you have big companies, we also have several companies that are enrolling on their own. And if you're large enough to do your own group, then you can start your enrollment date whenever you're ready. You can enroll the people in that group and then sweep those accounts. We do not count those in our tranches that you see on the website. So there's 3 additional groups enrolling right now that aren't part of these, what we call tranches. The tranches are just designed for agents all over the country to kind of combine together small businesses or individual people. So get those up and ready. A couple other interesting things from a marketing standpoint that you might want to use is we are getting the renewal amounts or credits that have been coming in. So in other words, if you were already in some of the groups, you're coming up on your renewal dates and you're getting your credits. So just to give you guys an idea of how the first 3 groups have been doing, I was in group 1. The first year, or on our anniversary, we were credited the 13% cap to the product, and our borrowing cost was 2.7. In the second group, they were credited 11.23, also with a borrowing cost of 2.7. Group 3 earned 12.97 credit with a borrowing cost of 2.3, and Group 1 renewed in the second year also with a 13% credit and a 2.7% cost of money. So we're all off to a fantastic start, and it's really, really good. Just you can use those as some of the marketing pieces or just for information in case people are asking you how they're doing. Also, what NIW has been doing is we've been doing agent training across the country on this Kaizen program, and we have had a lot of response, a lot of success, and a lot of people signing up. What we haven't been doing is trying to gear those presentations around agents being able to sell it directly to the client, because our job is to train the agent to sell it. However, we have been doing our own presentations to clients directly due to the banks and the attorneys and the CPA firms that we worked with in our traditional estate planning business, and we've gotten a lot of feedback from that, and so we have decided to develop marketing pieces that were designed for client presentation, and that is what you guys are going to be watching today. So what we are looking for from you is we're looking for feedback. We want to know, is this presentation giving the client enough information for you to be able to make a sale when you leave their office? If you think that there's not enough information, we want to know about it. If you think we didn't cover something, we want to know about that. And don't think about this from an agent selling perspective. Please think about this from I'm the client, you're pitching this to me, am I interested, do I want to buy it? The more feedback that you can give us, the better we can make these presentations. And what we're going to do with these presentations is We are going to start developing videos and webinars and all kinds of things that you'll be able to download from the agent login section on the NIW website. And it's all designed to help you make money. We don't make money if you don't make money, so the whole purpose of this is for us to work together. So you're going to be getting an email from John Rice, who's our marketing guy, and he will be sending that out to you to try to get your feedback. Please, if you have the time, give us that feedback because it only helps us help you. Okay. The only people that have heard this presentation, I just recently went to Las Vegas to do the National Life CPA Symposium, and I actually gave this presentation at National Life CPA Symposium. It was very well received. I had so many people trying to talk to me and ask questions that I ran into the next speaker and I kind of got kicked off the stage. So it was really, really well received, and we're very excited about this presentation, but we are still looking for feedback from you guys. So we're going to go ahead and get started. I think we still have a few people trying to log on, but I want to be respectful of your time and get started. So this program is one of 5 platforms that NIW has launched, and we have launched this program in the executive benefits space, and we've launched it as a executive bonus plan or 162 bonus plan, however you guys want to call that. NIW calls this platform Kaizen because Kaizen, the Japanese translation for Kaizen means significant improvement at little to no incremental cost. And we think this is the most exciting strategy in financing benefits in the market today. There's nothing like this. This number that you're looking at, $124 billion, is what the U.S. market is currently spending on acquiring what they call top talent. Employees are vital to the success of business, and businesses are spending a lot of money to recruit those employees. Unfortunately, once we recruit those and once we've spent that money to get them on board, we're now spending about 40 to 80% of our revenues in most companies to rewarding those people with benefits. The problem with benefits is we all look alike. There was a time when health insurance used to be a benefit. It's no longer a benefit. It is now mandatory as part of the salary package. 401ks or some type of retirement plan are about the same way now. If you don't have them, you're not even in the game. And the problem is, how do we set ourselves apart to offer benefits and recruit the top talent when we look just like everybody else? And employees want meaningful benefits to be competitive in the marketplace, and so you have to be able to offer competitive, meaningful benefits in an environment where costs are escalating and you still have to continue to grow your business. So if you're one of those companies that offers additional benefits over salary and health and 401k and vacation and sick pay and all those other things, and we just look at an average 45-year-old executive, and you say, well, at our company, why don't we offer, in addition to that, bonuses? Well, let's assume you decide at the end of the year you want to give an annual bonus of $12,000. Has this ever happened to you? You're going out, you're talking to somebody that you want to try to recruit away from somebody else's company, and you're going to try to set up an interview with them, and they say, yeah, I'd love to get together with you and talk about coming over to your firm, but I get my bonus paid in October, so as soon as I get that, then I can have a conversation with you. So these bonuses aren't doing exactly what they were intended to do, which is to keep them at your company. The other thing is, the opposite can happen. If they decide to stay at your firm and you give them that bonus based on levels or places they need to hit internal to your company, or where you'd like them to performance-based bonuses, what ends up happening is most of those people, if you don't give them those bonuses, come back and they're upset about it. And they basically say, I was using that bonus to pay my bills now, and if you don't pay me that, I can't pay for that new boat I bought last year when I got paid that bonus. So they become an expectation, and now they're angry at you because they didn't get their bonus, and so they're looking for another place to work. So then companies try to tie those to life insurance policies or other benefits that are longer term. Our webinars reach capacity, and so it keeps flicking up that nobody else can get on, and I'm not sure why that's happening, but you'll have to ignore that for just a second. When they do these $1 million bonuses or buy permanent life insurance, sometimes those have additional cash or supplemental income or deferred compensation or things like that. So you decide to do that and try to tie them to those benefits on a more long-term basis. And let's assume that that cost of that policy is $12,000 to buy this 45-year-old executive a permanent policy, but you have to do that for the next 20 years because he's only 45 and you're trying to retain him to retirement at age 65. So you're now committing the firm to $240,000. And the reality is most people don't even like life insurance benefits because they think two things. One, I'm never going to benefit from this. And second, once they get to that retirement age, it's no longer available. But more importantly, have you guys ever heard this? I don't want my spouse to go on the beach drinking margaritas off of my $1 million. If I worked myself into the bone and I had a death benefit that was left over, I don't want somebody else to benefit off of that. And it's a little bit morbid. And it's not that we don't want to protect our family. It's that we don't want to work really hard for the rest of our lives and then end up with a death benefit that we don't see any value from it. So let's talk about what employees want. Employees want meaningful, permanent benefits that cover their needs, and they want to be able to go to work every day and know that they have safety, protection, and peace of mind. As a matter of fact, Northwestern Mutual did a survey on America's greatest financial fears, and these are the top 14 of America's greatest financial fears. Now, if you look at this list, some of the things on this list we can't do anything about, and I'm going to point out a couple of those to you. Identity theft. There's nothing that we can do about identity theft. There's nothing we can do about poor credit or being a victim of financial scams or bankruptcy. So let's focus on the ones that we can actually do something about. The number one greatest financial fear is financial emergencies. People don't want to put money away on a long-term basis tied up in some account they can't access until they're 59 and a half in the event that they might have some unforeseen financial emergency. Now that could be something like, you know, somebody in the family gets sick and they need access to that money, or that could be something along the lines that they lost their job and they need access to that money to make it to the next job. The next number two on that list was not enough money saved for retirement. Everybody is scared to death that they aren't going to be able to make it through retirement in the lifestyle that they're accustomed to because they haven't saved enough. Number three is medical expenses due to illnesses. Number four is outliving retirement savings, inability to afford health care, financial burden to the family, and very bottom, death benefit of the primary breadwinner. Now, it's interesting considering that most people do need a death benefit, that's the very bottom of the platform. But let's look at each one of those benefits and let's talk about those. And we're going to put them into two different buckets. The first bucket we're going to put that in is supplementing our income. And let's talk about the financial fear, and then we're going to talk about the solution. First off, the financial emergency and not having access to that money in the event that you need it is very well founded in the fact that nearly half of Americans are one disaster away from a financial emergency. Medical problems contributed to 62% of all personal bankruptcies filed in the United States. So what if we had a plan that would give us access to that money before we were 59 and a half? Not enough money saved for retirement was the second on that list. And if you look at the average person out there, and let's assume this 45-year-old executive was earning $200,000, federal income taxes come off the top, Social Security, Medicare, and if we're assuming they live in a state that we didn't have to take out state, city, or any other deductions, that person's take-home pay is actually $138. $62,000 came right off the top. And so how difficult is it for us to save money? But what if we had access to the use of that money? What if we didn't have to just take it right off the top and not be able to use it? What if we could use that money to save for retirement and then pay it later? Outliving retirement savings. 1/3 of all U.S. households between the ages of 30 to 59 won't have enough money for retirement, even if they work until the age of 70. So what if we had a product that would give us a guaranteed income? If we lived to 120, it wouldn't make any difference because we could take our income and get a guaranteed income for the rest of our lives. Inability to afford health care. The average 65-year-old couple retiring today in 2012 is estimated to need $240,000 to cover medical expenses through retirement. What if you could have that coverage, but you didn't have to pay for it unless you used it? Now let's talk about the protection side. Financial emergencies, this is what we're talking about due to medical expenses. This is what we're talking about when we're talking about the protection side. We're going to talk about the financial fears again in the solutions. Medical expenses due to illnesses. Illnesses that we're talking about are like heart attacks and stroke and renal failure. Heart disease is the #1 cause of death for both men and women in the United States, claiming 1 million lives. And what I thought was the most interesting thing about this particular statistic, 1/2 of those victims are under the age of 65. So a lot of people think about illnesses after they retire, not necessarily before they retire. And anything that you look at in this list is the same. Lots and lots of people are going to have issues before the age of 65. So what if you had a product that would provide you critical illness coverage? Financial burden to the family. These are the people that need assisted living, or they need help dressing, or they need help bathing, or something along those lines. The average person retiring today will have an almost 70% chance of needing some type of long-term care service. On average, women are going to need about 3.7 years, and men will be about 2.2 years. So what if you had a platform that would allow you chronic illness care? And then let's talk about premature death of the primary wage earner. 70% of U.S. households surveyed said they would have trouble meeting expenses within a few months if the primary wage earner were to pass away today. So what if we also had life insurance? Now, the problem with most families is they only have a certain number of dollars to spend. So do they save more for retirement, or do they provide more for protection? They no longer have to do that. We are providing the solution and the choice, and that's called Kaizen. Kaizen will allow us to provide in one benefit all the protection, all the supplemental income, and we will get a lender to participate in the additional contributions to that plan so you don't have to use all of your own funds. Now, let's look at the protection again. This program gives you protection. You buy a life insurance policy, and that death benefit is, in this example, let's say that the death benefit is $1.5 million. And with this particular life insurance policy, it will allow you to access that death benefit while you're alive. So if you have any of these critical illnesses, you can accelerate that $1.5 million, and you can get that money up front today. So if you had a heart attack, they would write you a check for a percentage of that death benefit. You can take some of it, you can take all of it. If you choose to take all of it, it'll cap out at $1 million. But the point is that they will accelerate that death benefit and pay it to you today. Now, this is also called critical injury. It will also cover coma, paralysis, and things like that. In the event that any of these things happen to you, you can also accelerate that death benefit. It'll also cover chronic illnesses. So anyone who needs an assisted living facility or needs to bring in somebody to their home to help take care of them in the event that they need help bathing, dressing, toileting, eating, any of those things, All they have to do is have a doctor's note that says they can't perform 2 out of the 6 activities of daily living, and they will be given money up front up to 2% of that death benefit accelerated on a monthly basis. And that goes up to $1.5 million. And then terminal illness. If one of these clients found out that they had a terminal illness and they were going to pass away within the next 24 months, they would be able to accelerate a part or all of their death benefit and get that up front today. Now, on the other side of the equation, all the additional money that you're putting into this platform, you can grow in that with market upside. So it's going to give you the market indices like an S&P growth without any of the market risk. And the way they do that is they give you interest credits based on the positive changes in that market. Now, on the downside, they give you no market losses because they give you a guaranteed minimum interest rate. That product is going to allow you to grow that account tax deferred, and the more that you tax deferred, the quicker you're going to reach your goals and compound that to get to you the most savings that you can possibly get to your retirement. And using policy loans, you can pull that money out tax-free. In addition to that, this particular product has a lifetime income option so that when you get to retirement, if you choose to take all those cash values and swap it out for an annuity, you can now get a lifetime income offer. Now, the way they're doing that is they're doing that based on the death benefit, so they will actually loan you part of it all the way through your lifetime so that you get that in a tax-free environment so that you do not have to pay taxes on that. And last but not least, we are going to allow you to leverage the account so that you only have to put in 25% of the total contributions over the 10-year funding period. And I mean you as in you and your employer. So of the 25% contribution on this 45-year-old executive, this can be you putting in 100% of it, you and your employer putting in portions of it. We have some companies that are doing 100% of the contributions for their employees. We have some individuals that are paying 100% of their own contributions, and then we have some companies that are doing some form of match where they might be splitting up the contributions between the employer and the employee. So you will be making your contributions over a 5-year period of time, and over that 5-year period of time, the lender will be matching the amount that you're putting in there over that 5-year period of time. And at the end of that 5 years, the lender is going to continue to fund that for an additional 5 years at 100% of both contributions. And the best part of this plan is there's no financial underwriting and no loan documents that will ever be signed by the client. The policy is the sole collateral, and the borrowing rate is LIBOR plus 1.75. So in today's market, that means all in, we're going to be able to get a loan at about 2.7%. Just so you know what that looks like, if you put your own money into this program, and we are using the same $172,000 contribution for 45-year-olds, you put in the $172. In Kaizen, you put in the same $172, and the bank contributes an additional $500,000. Now, in today's environment, that would generate an income stream of about $49,000 from age 65 to 85. And that means you're going to be able to pull out about $980,000 of that platform, of that cash in that program. If you use leveraging using the same assumptions, that goes from $49,000 to $90,000. That means you've pulled out $18 million. This is a wrong number. Sorry about the typo. We'll fix that. But you've been able to pull out about $18 million. Not $18 million. Sorry, $1.8 million. So the difference is a huge difference by just leveraging that piece up. Now, a lot of agents will say to you, well, what happens if the market doesn't perform? Well, think about this side by side with the 401k as well. If you put your money in, the market's going to do what the market's going to do. Whatever dollar amount you get to and whatever dollar amount you can pull out, you're using that same number. When you add the leveraging, you're just leveraging it up to get more. That's all you're doing. So the numbers don't mean so much. What really means a lot in this example is the difference between how much more you can add to your income just by having the ability to use somebody else's money. So think about this from the standpoint of you walk into your employer-employee benefit meeting, and now your employer is saying to you, this is what your benefit platform looks like. And if I offered you this benefit today, how much would you contribute? So the first thing I say to you is, we have a matching program here, and for every dollar that you put into your plan, we will put some portion, you can put some portion, or we'll put in 100% for you. But we have facilitated a lending platform here that would allow us, after 5 years, to continue to contribute to this plan, so that ultimately we're going to put in 75% additional dollars. We're not going to underwrite you for this loan. We're not going to have you sign any loan documents. You're merely going to assign the assets to the lender until the loan is paid off. We're going to give you a pricing of 1.75, LIBOR plus 1.75. And that program is going to provide protection in death or any living illness that you think you might possibly have between now and the time you retire. But on the other side, every dollar you put in there, you're going to be able to participate in the upside of the market without any market risk on a tax-deferred basis, pulling those contributions out tax-free. You can use this money for the next 15 years to accumulate as much as you can possibly accumulate at retirement before you have to pay off that loan. How much would you put into this platform? Now, I'm in the platform, so I can tell you everything you can possibly afford is what you're going to put into this platform, because there's nothing like this on the street. Now, a lot of people say, this is too good to be true. And the analogy that I like to use is, if you think about Hershey's chocolate and the peanut butter company. Hershey's is a very successful company that's been around since the 1800s. Who knows how long Peter Pan's been around. And somebody came along and said, wow, wouldn't it be great to combine those two companies and have a new product that we rolled out to the street called Reese's Peanut Butter Cups. And that's the way I like to think about this plan. There is nothing new or unique or different about what we're doing. All we did was think about bringing multiple parties together and launching a new platform in the marketplace. And what are those new parties? Lenders, been around loaning money to individuals forever and ever. Product, life insurance products have been around since the 1800s. We need a specialized structure, which is a trust structure. Trustees have been managing clients' assets for years and years, and then somebody to monitor that and do the case design and support. And NIW has been doing this since 2000 for our wealthy clients, and we have facilitated over $4.7 billion in this exact same type of platform. Now we've just been able to make it available for executives. So let's talk about each one of those platforms. First, the lender. We have multiple lending sources. We have set up a very specific loan structure. So most people think about a loan structure like a margin account or a house or a car or something like that. We've set up a loan structure to allow them to lend to us on our benefits as opposed to maybe a house. We have an exceptional reputation with our lenders. They have never lost a penny with any of our lending platforms. And we have great terms and conditions, LIBOR plus 1.75, and they have given us a capacity to write $125 billion a year for this program. Now, if you think about what we use financing for, this is a typical financing transaction. A client has $100,000, they want to go out and they want to buy a property. And they invest that $100,000 into that property, which they want to sell later down the road for a better rate of return. What a wealthy client does is they take that same $100,000 and they leverage it with the bank. So they put $25,000 down on the house and they borrow $75,000 from the bank, and now they can buy 4 houses. Now, a lot of people don't want to take the risk that they're going to lose money to the lender by selling that investment and it not being enough to pay back the bank. But if we took away the investment risk on these houses and said, these houses are going to have expenses and fees and costs. You have to buy flood insurance, you're going to have to fix the flooring, and you're going to have to maybe change out some tile. We can't change the expenses or fees that you're going to have to incur on those houses. But what we can do is fix the investment. So if the house is worth $100, we will guarantee that the house will never be worth less than $100,000. Now, if I could say that to you, would that change the risk on this transaction to borrow? And that's exactly what we've done by using the index products in this platform. They have guarantees, and the guarantees mean your principal will never be less than what you put into the plan. Now, you need a unique product to do that, so let's talk about the product for just a second. National Life is one of the companies we're using. We have multiple companies, but let's focus on this one for just a second. National Life has been around since 1848. For those of you who are familiar with New York Life, that's 2 years younger than New York Life. First policy sold in 1850. They have an AM Best rating of A, and they have a total adjusted capital at $13.5 billion. Now, the product that they're using is a product that's been on the street for a very long time. It's called an index life product. But what a lot of people don't understand when we say index is they're thinking index fund. This is how an index product, life insurance product, works. They have a general account, which is basically an investment grade bond portfolio. However, what a lot of people aren't familiar with is insurance companies buy principal protections on those bond portfolios or those investment grade bonds. Now, if they buy those bonds and they hold them to maturity, they don't have the mark-to-market risk on those. So they are going to get what those bonds are worth because they will hold all of them to maturity. And they're going to buy them at various times, and so they're going to have a blended portfolio. In today's market, that current blended portfolio is 5%. So let's assume that we pay $110 of our money into this platform, and $10 is coming out to cover all the protections we talked about earlier. So our death benefit and our living benefits and all of those other fees and expenses, and we have $100 remaining. If I put my $100 in that index product, it's going to give me principal protection that I can't lose my $100, and it's going to give me the current fixed yield on that account, which would mean at the end of the year I would be at $105. How an index product works is I am taking that $5 they were going to pay me in fixed return, and I'm going to allow the insurance company to buy an option on the S&P. When you purchase an option on the S&P, you only have $5 to spend. So in today's market, that will buy me up to 13% of the upside growth of the market. So if the market goes down when I buy my option and it takes a negative loss of 20%, my $5 expires and I lose my $5. However, if the market goes up by 5%, I'll get credited 5. If the market goes up by 8%, I get the 8% credit. If it goes up 13, I'm going to cap out at 13. If it goes up to 20, I still have 13. So if you assume that costs have already come out, and I'm assuming that the client is paying their costs for the insurance and protection out of pocket, and you look at the way that you fund these platforms, if you put $10 in there every single year to cover your cost, and then you put an additional $90 in there to get a rate of return, and in this example, whatever of the upside growth that you can get, every single year that you add to that, you still have a very small cost percentage versus how much cash you have in there to get a rate of return. So by the time you're in year 4, you've got a very small cost drag, but a big cash pot to be able to get upside of the market. So if you got no growth year 1, no growth year 2, no growth year 3, but in year 4 you had $400,000 in the account versus a cost drag of maybe $20,000, and you got a 10% credit or a 13% credit, you're going to get a great rate of return. Now, your cost structure has already come out versus the money that you're putting in there, but what happens when you borrow now from the lender? Your cost structure doesn't change. Your cost and fees and expenses have already come out. So you don't have the same cost drag on the lender's money that you put in there. What does that mean your risk is on the borrowed money? It's the cost of insurance. So the analogy I like to use with that is Dave Green's analogy, which basically says if you pulse $100 out of an ATM machine, the fee on that $100 is $3. But if you pulse out $400, you still have a $3 fee. So if you use that analogy with these premiums, your fees and expenses are already coming out of your portion of the contribution, and so your lender contribution only has that additional risk of small fees and expenses and a little bit of the interest on the loan. So let's just look at an indexed life insurance policy versus an index fund. And I'm only talking about the excess growth. I'm not talking about the cost of the life insurance itself. If the market goes up by 20% in the index fund, I would be at $120. In the index policy, I would have capped out at my 13%. Now I'm going to assume next year that I still have a 13% cap on my product, and the market goes down by 40%, and I've paid my cost for the insurance out of pocket. And now my account balance with the index fund is at 72, and with the life product I'm still at 13. And in year 3 I'm going to assume that I still only have 13% cap on the product, or that's as much of the capture of the market as I can get. And I'm still going to assume that I've paid my cost out of pocket, and the market goes up by 25%. And now in my index product I have $127 versus my index fund, which is at 96 and not even back to even. So the point of this particular platform is to show you how the investment side of this product works. So the next thing, we need a structure. Just like if you went over to TD Ameritrade and you wanted to open an account, or you went to a bank and you wanted to open up a money market or a mutual fund, we are going to do the same thing with this structure. However, the difference is we're going to use a trust. Why? We can have a trustee manage this asset and make it bankruptcy remote from the company and protect it from everybody else that's in my group or my platform. So in my example, I open up my trust and I contribute my $32,000, or my employer contributes my $32,000, or half and half, or however we want to pay it. And then I am going to designate my own beneficiary, and I'm going to wait for all the other people that are in my group or being collected from other people across the country, and everybody else is going to do the same thing. They're going to open up their own trust, designate their own beneficiaries, and make their own contributions into that trust. Once I have significant mass, I can go to the lender with a different trust, and that trust's sole purpose is to go negotiate a loan with the lender at a high amount. So I'm going to borrow, let's say, $2 million from the lender, and the lender is going to ask where my collateral for this $2 million loan is, and I say each one of these accounts has been opened up and deposits have been put into those accounts, and those deposits will add up to the $2 million I need to borrow. The lender will give me the $2 million loan at the LIBOR plus 1.75 pricing. I will sweep all these accounts. I will add my $2 million to that. I will send $4 million to the insurance company. The insurance company will issue individual policies to each one of these trusts. The trustee will assign those policies to the lender as the sole collateral for the transaction, and as soon as the loan is paid off, we're estimating that to be year 15, the assignment will be released, and each one of these people has their own insurance policy in their own internal trust. Now you need somebody to monitor these platforms. NIW has been doing that for wealthy clients since 2000. That's all we do is premium financing. We have placed loans with some of the largest lenders in the world and wealthiest clients. We have facilitated today over $4.7 billion of loans with the highest persistency and the lowest failure rate. And what I mean by that is we are 5% plus or minus where we illustrated to our clients we were going to be on this platform. We have been servicing these accounts every single year. We even serviced them through the financial crisis when all of our competitors lost their lending. We continued to fund our existing cases and wrote as much new business that year as we did the previous year. It did not register a bleep for us other than we didn't grow as much as we had the other years. And we have the highest success rate and lowest failure based on our designs. And that's not coming from us. All of the companies that we work with will tell you that information. So don't fall behind. Offer the best benefit that's on the street. Kaizen is, bar none, like nothing else out there. Once you combine all the players and all the platform, you aren't going to be able to find any other thing that you're participating in, whether you're talking about 401k or whether you're talking about a deferred comp with your company. With the leveraging piece, with the risk reward, with the tax advantages, there's nothing like it on the street. So I am going to now thank everybody that needs to get off and go do something else. Have a fantastic weekend. And I'm going to actually allow people to ask questions. So if you want to stay on for the question and answer part of this presentation, thank you. I really would appreciate anybody giving feedback when you get John's emails asking for feedback. So if you would like to ask questions, there is a little button that allows you to